Welcome to our Freeman Report presentation. Today we're going to discuss Carrizo Oil and Gas. Our agenda today contains the following topics: company description, operations overview, industry and peer analysis, risk analysis, investment summary, revenue and production growth model, and valuation methodology. Carrizo Oil and Gas is a Texas-based independent energy company. They primarily focus in horizontal drilling and hydraulic fracturing technologies. They currently have a market capitalization of approximately $950 million and proven reserves of 115 MMBOE at year-end 2012. Carrizo currently operates in 5 locations: the Barnett and Eagle Ford shales in Texas, the Niobrara Formation in Colorado, the Marcellus Shale in the Appalachia, and the Utica Shale in eastern Ohio. The Eagle Ford Shale is one of the hottest places in the U.S., making Carrizo an important player in the industry.
The energy industry plays a key role in U.S. economy. The U.S. has almost 3% of the world's proven crude oil reserves and accounts for about 9% of production and a quarter of world demand. The recent boom in resources, as well as new technology innovations, have attracted investor companies and created a whole new market with enormous growth potential. The U.S. oil and gas industry is affected by the following macroeconomic factors: economic growth, overall demand and supply, geopolitical risks, and the dollar's currency strength. Gas prices in the U.S. have fallen because of high production and supply. This supply has led to a slowdown in gas drilling. Oil and gas prices are the main driver for E&P companies, and generally will define if a resource is deserved to develop or not. According to consensus estimates, oil and gas prices are likely to stay volatile in 2013, but around the $90 and $4 level respectively. Carrizo, as well as dozens of small-cap group of companies, participate in the E&P industry. In our analysis, we use similar companies based on the following factors: market cap, return of equity, price to earnings, price to cash flow, enterprise value to EBITDA, price to BOE reserves ratios. Carrizo Oil and Gas performs on average better than its peers. There are several risks that affect E&P companies, which we believe are operational risk, financial risk, and regulatory risk. Among those, we believe that the debt risk affects Carrizo the most. Carrizo has a long-term debt of approximately $950 million and a total debt-equity ratio of 76%, which means Carrizo is much more aggressive in financing its growth with debt than its peers. Luckily, at the end of 2012, Carrizo sold their legacy property in Louisiana and their interest in the UK Huntington field for about $200 million. This will allow Carrizo to focus in the US property and finance their 2013 capital expenditure budget without incurring in further debt.
In our investment thesis, we consider 5 factors that make Carrizo an attractive prospect to investors, those being a balanced portfolio of low-risk reserves, an efficient capital allocation, focus in hydraulic fracturing technologies, high operation control, and aggressive hedging strategy. We will explain each one of those in the following slides. As mentioned before, Carrizo operates in shale formations in the U.S. Given their 99% drilling success rate, we have characterized their reserves with a low-risk profile. At year-end 2012, Carrizo had 115 MMBOE in proven reserves. Of those 115, 56 were proven and developed, and 59 were proven but undeveloped. Most importantly, Carrizo estimates their probable reserves at 400 MMBOE in their currently owned properties. We believe that these reserves will facilitate growth in future years and provide great value to investors. Carrizo has a capex budget of $624 million in 2013. Of those $624 million, Carrizo plans to spend $384 in the Eagle Ford Shale, $70 in the Marcellus Shale, $35 in the Niobrara Formation, $10 in the Barnett Shale, and $124 in land and seismic activities. As we can see, Carrizo is concentrating its efforts in the liquid-rich Eagle Ford Shale, which we believe is the correct strategy given today's market conditions. According to a revenue model, Carrizo will be able to finance its budget with the sales of their UK and legacy properties and their cash flow from operating activities. Carrizo is a leader in horizontal development drilling technology. This advanced technology in the drilling segment can help Carrizo realize production efficiencies at lower cost and guarantee Carrizo's strong growth in the market. Since Carrizo began focusing a significant portion of its efforts in shale plays in 2003, he has maintained an annual production growth rate of approximately 25%. The technology-driven drilling program enables Carrizo to achieve a 99% drilling success rate. We believe it holds technical advantage from its extensive drilling experience. Therefore, we expect Carrizo to generate high revenues from increasing production amounts. Energy commodity prices are very volatile and directly affect E&P companies' revenues. Carrizo typically controls the operation of their joint venture wells. They hold an average interest of 73%. This high percentage of interest provides Carrizo with great financial flexibility, meaning that they can adjust their capital expenditures in response to commodity prices.
Carrizo's management team has made well-diversified hedging strategies to lock high commodity prices. In the last 2 years, the oil market has been more attractive for E&P companies. Carrizo did not stay behind, and they took aggressive hedging strategies to guarantee prices. In 2012, Carrizo's average oil price was 100.5 per BBL, a 6% increase over its 2011 price. Carrizo's strategy for 2013 is to hedge 85% of its oil production at 89 per BBL or higher. Due to the depressed market for natural gas, Carrizo is increasing its oil production to offset the effect of weak natural gas prices. This works as a natural hedge. And it is going to hedge the remaining 2013 natural gas production at a weighted average floor or swap price of 4.6 per MMBTU. The main drivers of our revenue model were consensus estimates of oil and gas prices, expected production growth, and capital expenditures. We believe that by 2014, Carrizo will be able to finance their investment activities to a $550 million per year level, with only zero cash flow from operating activities and also start paying off long-term debt. As we can see in graph, the Carrizo stock price has been volatile during the last 5 years. This is no surprise given the cyclic nature of the energy industry. Also, during the 2008 real estate crisis, not only energy companies, but the whole market suffered heavy declines. However, as market conditions improved, Carrizo's stock price has remained fairly stable during the 2 last years. During 2013, the stock price has risen from $20 to its current price of $27. We have set our 1-year target price at $31. We used the weighted average of 5 valuation methods to calculate our $31 target price and a market outperform rating. The methods we used were 10-year net asset value using discounted cash flow analysis, and the following multiples: price to BOE proved reserves, enterprise value to EBITDA, price to cash flows, and price to earnings. We believe this approach is the best when evaluating an E&P company. The stock price path in 2013 supports our results. Thank you very much for your patience.